Welcome back, everyone. Feels like we just stepped off that spin cycle ride at the amusement park with This Week in the Markets. Big tech earnings, elections looming, and the economy throwing some serious curveballs.
You said it. Definitely a lot to unpack.
But that's why we're here, right? To break it all down. Today we're diving deep into the closing market report, dated November 1st, 2024. Think of it as your cheat sheet for the week, especially if you're trying to figure out how all of this market madness impacts your own investments.
Absolutely. This report really captures the highs and lows, especially for those of us who want to know how those big economic trends impact our portfolios.
So let's jump right in. One thing that really caught my eye was that jobs report. Only 12,000 new jobs in October. That's like way lower than anyone expected, right?
Yeah, it definitely raises some eyebrows. And, it comes right after the Fed decided to cut interest rates.
Didn't they cut rates in September?
That's right, they did. Partly because there were already some worries about the labor market slowing down.
So this report kind of confirms those worries weren't unfounded.
It does seem that way. And here's the kicker. The report also mentions that job growth numbers for August and September were actually revised downward, too.
So it wasn't just a sudden dip in October.
Seems like the slowdown has been brewing for a while now, maybe longer than we initially thought.
That's interesting. And what does this all mean for the average investor, someone who's maybe just getting started or trying to plan for their future?
Well, it makes you wonder, what will the Fed do next about interest rates? Will they cut them again to try to give the economy a boost? Or will they hold off because of other factors like inflation?
It's like walking a tightrope, isn't it? Cutting rates could stimulate the economy, but also potentially lead to higher inflation.
Exactly, it's all about balance.
Speaking of inflation, I keep hearing about rising Treasury yields, and honestly, I'm still not 100% sure what it all means for me as an investor. Like how it actually affects my money.
It's a common question and a really important one. Basically, rising Treasury yields are often a signal that investors are worried about inflation. And when inflation rises, it can erode the value of your investments, meaning your money doesn't go as far.
Okay, so rising yields are kind of like a warning sign, a heads up that inflation might be on the horizon.
That's a good way to think about it.
But how do yields actually affect my investments? I mean, I'm more into stocks, not bonds.
Well, even if you're not directly investing in bonds, rising Treasury yields can still have an impact. See, they can make bonds more attractive to investors compared to stocks.
Meaning investors might shift their money from stocks to bonds.
Precisely. And that can put downward pressure on stock prices. Plus, when yields go up, it costs companies more to borrow money, which can impact their profits, and as a result, their stock performance.
So even if I don't have any bonds in my portfolio, those rising yields can still affect my stocks.
Absolutely. It all ties back together. It's like a domino effect.
Wow. Okay, so that's something to keep an eye on. But let's move on to something a little more, well, exciting. Earnings reports, especially from the tech giants. Amazon seems to be on a roll, but Apple's news has left some investors feeling a little, well, underwhelmed.
Yeah, it just goes to show how expectations drive the market. Amazon blew past those expectations. Their forecast for the holiday quarter looks really strong, and boom, their stock soared. Apple, on the other hand, even though they beat earnings estimates, their guidance wasn't as impressive as some were hoping for. It's a reminder that past performance doesn't guarantee future success, and investors are always trying to predict what's next.
It makes you wonder what the future holds for other companies that reported this week, right? Like Intel, Chevron, Boeing. They all had some positive news, but what does it all actually mean?
Well, let's take Intel, for example. Their stock bounced back after a bit of a rough patch. Their data center and AI revenue grew significantly.
So are those good signs for the company's future growth?
It seems to be pointing in that direction, yeah. Now, Chevron, their profits dipped a bit due to lower oil prices, but they actually increased production.
Interesting. So even though their profits were down, the fact that they're producing more is a good thing.
It suggests there's still strong demand in the energy sector, which is worth watching. Then there's Boeing. Their stock surged on news that could potentially put an end to a strike by their machinists' union.
So if the strike ends, that's good news for Boeing.
Big time. It could be a game changer, signaling smoother sailing ahead for the company.
So we've got a bunch of interesting clues about the health of these individual companies, but we can't ignore the elephant in the room, the upcoming election.
Oh, yeah. It's definitely creating some uncertainty. You can almost feel the tension in the air.
Right. And how's all this political uncertainty affecting the markets?
Well, markets and uncertainty are like oil and water. They just don't mix. Investors hate not knowing what's coming next.
Because they're trying to predict what the political landscape will look like after the election and how that might impact the economy and their investments.
Exactly.
So the election is basically a giant question mark hanging over the market right now.
You could say that. And the longer it takes to get clear election results, the more that uncertainty will linger and the more nervous investors are likely to become.
So we could see some big market swings in the days and weeks following the election, especially if the results are close or contested.
Absolutely. We could be in for a roller coaster ride. Buckle up. It could be a wild ride for sure. And, beyond the election results themselves, the report also mentioned that control of Congress might not be clear right away either.
Oh, right. And why is that a big deal for investors? I mean, isn't the presidency the main thing?
Well, control of Congress is important because it influences which laws get passed, which policies get enacted, and those can have a huge impact on the economy, on businesses, and ultimately the stock market.
So it's not just about who's in the White House, but also about the balance of power in Congress.
Exactly. And if we end up with what's called a divided Congress, where one party controls the presidency and the other party controls one or both houses of Congress, well, it can lead to gridlock and make it harder to get things done.
And that uncertainty makes investors nervous.
You got it. It can make them hesitant to invest, and that can create more volatility in the market.
Okay, so lots of moving parts and lots of potential for market swings. But before we get too caught up in the election drama, let's talk about something called market breadth. The report mentioned that it's been retreating lately. What does that even mean?
Think of market breadth as a measure of how many stocks are participating in a particular market trend. When market breadth is expanding, it means more and more stocks are joining the rally.
So it's like a party where everyone's having a good time.
Exactly. It's a sign of strength and sustainability. But when market breadth starts to retreat, it means fewer and fewer stocks are doing the heavy lifting.
Oh, so it's like the party's still going, but some people are starting to head for the exits.
That's a good way to put it. And the report specifically mentioned that the percentage of S&P 500 stocks trading above their 50-day moving average has dropped quite a bit since early October.
Okay. And that's not a good sign.
Well, the 50-day moving average is a technical indicator that many investors use. When a stock is trading above that average, it's usually considered a good sign, a sign of strength. So the fact that fewer stocks are trading above that average could be a signal that the market's momentum is slowing down.
Okay, so that's a little concerning. Is there anything in the report that gives us a reason to be optimistic? Any signs that the market might keep going up, even if it's at a slower pace?
Well, one positive point is that earnings this quarter have been pretty solid overall. The report mentions that FactSet, a financial data company, has actually raised its estimate for earnings per share for the third quarter.
So companies are still doing pretty well.
Seems that way. They're still generating profits, despite all the economic uncertainties out there.
That's reassuring. But the report also mentioned some concerns about the technical setup for some of the Magnificent Seven stocks. Companies like Meta, Microsoft, and Apple. I mean, those are huge companies, right?
Yeah, they're like the giants of the tech world.
So what's the concern there?
Well, those 7 companies, Apple, Microsoft, Amazon, NVIDIA, Alphabet, Tesla, and Meta, they've become so dominant that they have a really big impact on the performance of the major indexes, like the S&P 500.
So if they do well, the whole market tends to do well. And if they struggle, the whole market struggles.
That's the idea.
Oh, correct.
And the report is suggesting that their charts are starting to look a little shaky, which could mean they're due for a decline.
So even those big tech giants are showing signs of weakness. Does that mean we should be worried?
Not necessarily. The market is always going to have its ups and downs. That's just the nature of it. The important thing is to focus on your long-term investment goals and make sure your portfolio is diversified enough to handle any market fluctuations.
Diversification, right.
Yeah.
Don't put all your eggs in one basket.
Yeah.
Got it. But let's talk about something that surprised me. The report mentioned that the UK's recent budget announcement actually had an impact on U.S. Treasury yields. How is that even possible?
It might seem strange, but the global financial markets are more interconnected than you might think. The UK's new budget includes a lot of spending increases, which has made some investors worried about inflation. Not just inflation in the UK, but potentially inflation in other countries as well.
Oh, so those inflation worries are back to haunt us.
It seems so. And when investors get worried about inflation, they tend to sell bonds, which can drive down bond prices and push yields up, including U.S. Treasury yields.
So wait a minute. Does that mean that what happens in the UK can actually affect U.S. interest rates?
Well, the U.S. Treasury market is the biggest bond market in the world. It sets the benchmark for interest rates globally. So when U.S. Treasury yields go up, it can affect borrowing costs for businesses and consumers all over the world, including in the U.S.
Wow, it's like a domino effect. Something happens in one part of the world, and it ripples through the entire global financial system.
Exactly. And that's why it's so important to pay attention to what's happening not just in the U.S., but in other major economies as well.
Okay, so we've talked about the jobs report, tech earnings, the election, and even the UK budget. But we haven't talked about how investors are actually feeling right now. Now, what's the overall mood in the market?
That's a great question. Market sentiment, it's like the emotional undercurrent of the market. We can look at all the charts and data we want, but at the end of the day, it's human emotions, fear, greed, optimism, pessimism that really drive those buy and sell buttons.
So how can we get a sense of that mood? Like, how are investors feeling right now?
Well, one way to gauge market sentiment is to look at the SIBO Volatility Index, or VIX, which is often called the Fear Index.
The fear index. Okay, tell me more.
Basically, it measures how much investors are willing to pay to protect themselves against potential market swings.
So if the VIX is high, it means investors are nervous, like they're expecting a lot of volatility.
Exactly. It's like they're bracing for impact. And right now, the VIX is sitting at 21.88, which is considered elevated. It tells us that even though the market managed to claw back some of its losses this week, investors are still on edge, still a bit jittery.
Makes sense with the election, the Fed meeting, and all those economic question marks still swirling around.
Yeah, there's a lot to be uncertain about right now. It's like the market's holding its breath, waiting to see what happens next.
So we've talked a lot about the potential for election-related volatility. But what does that actually mean for us everyday investors? Like, what should we be prepared for?
Well, we could see some pretty big market swings, maybe even bigger than what we saw this week, especially if the election is close or if it takes a while to figure out who won. That kind of uncertainty can make investors act a little, well, irrationally.
So you're saying we should buckle up and get ready for a potential roller coaster.
It's definitely a possibility, and the longer it takes to get a clear winner, the more nervous investors are likely to get, and the wilder that roller coaster ride could become.
Got it. So we've got the election, the Fed meeting, economic data coming out, a lot to keep track of. What's the best way to stay sane amidst all this market chaos?
Honestly, focus on the long game. Don't let those short-term market swings derail your overall investment strategy.
So don't panic and sell everything when the market dips.
Exactly. Stick to your plan, stay disciplined, and resist the urge to react emotionally to every little market blip.
Solid advice. What else should investors keep in mind?
Remember the power of diversification. Spread your investments across different types of assets, stocks, bonds, real estate, whatever makes sense for your goals. Don't put all your eggs in one basket. That way, if one part of the market takes a hit, you're not completely wiped out.
Diversification, it's like having a financial safety net, right?
That's a great way to put it.
Any other pearls of wisdom for our listeners before we wrap things up?
Stay informed. Keep learning about the markets and the economy. Read, listen to podcasts like this one. Do your own research. The more you know, the better decisions you can make.
Knowledge is power. And I have to say, this deep dive into the closing market report has been incredibly helpful. I feel like I have a much better grasp on what's happening in the market now.
That's what we aim for. We want to help you understand the market's complexities and make smart choices for your financial future.
And on that note, I think it's time to wrap up this episode of The Deep Dive.
It's been a pleasure, as always.
Thanks for joining us on this journey through the market's twists and turns. We'll be back next week to break down more financial news and help you make sense of it all. Until then, stay curious, stay informed, and stay invested.
And remember, even in the midst of all the uncertainty, there are always opportunities out there.